Okay, we are all set. And then Kevin, do you guys still have the screen?
Yep, I'm able to see it
Okay,
still.
awesome. I've got my two monitors. Well, welcome everyone. My name is Katie Ray. I am an agent with Good Neighbor Realty. I'm also a real estate investor with my husband Sam, who's sitting on here. And today we're going to dive into how owning more can help you owe less in taxes. So, real estate strategies to slash that tax bill. Today, we have our guest speaker who will actually be doing most of the talking. This is Kevin. Kevin wave, since we have so many people's cameras on.
Hello.
Kevin is our personal CPA, but he has taught us a ton, and we are very grateful. About 3 years ago, when it finally wasn't easy enough to just go on TurboTax and do it ourselves, Kevin came into the picture and has taught us a lot. So, yeah, let's dive in. I'm gonna share a little bit about myself. I'm married to Sam here. I'm also a dog mom. I have two pups who are our kids. I'm a runner, a hiker. I love to read, I love to bake, I love nice restaurants, and I'm actually also a florist, which for some reason everyone finds the most fun. But I've been dabbling in that for a few years, and it's become a lot more real in the last year. My background is in financial advising. If these words mean anything to you, infinite banking, velocity banking. I was in tax strategy straight out of college. And we were using life insurance as a tax strategy or haven, for lack of better words. And then I've also done underwriting for Rocky Mountain tech startups via a bank called Bridge Bank, and we were in venture debt. So that's a bit about me today. I'm a real estate investor, a house hacker specifically, and I'm also a general partner in an 87 unit 21.7 million multifamily property in Athens, Georgia, which is actually where Kevin has some property as well. One funny thing today is that I am a Florida Gator and Kevin is a Bulldog. So that's something that if you know anything about the SEC, those are our rivals, but we still manage to work together. So. Before we dive into what we're all here for today, which is number four, depreciation, I'm going to talk through the real power of real estate, and this is for more of the newbies on the call. Um, this is actually something Kevin shared with Sam and myself when it was one of our first meetings a few years ago, and it was 4 points to real estate of why this has become our chosen method of investing. That first one is the obvious one that everyone wants. It's the instant gratification cash flow. It's almost passive income. Kevin will get into why it has to be almost and not pure passive income. And then I like to think about like when we went into our house hack, we were saving on our quote unquote living expense because we were no longer paying our mortgage on our own. So you're either supplementing your income via an investment property or with a house hack, it's a very direct, those numbers feel very direct. That second point is appreciation. These are pretty significant numbers to me in Colorado, specific to single family homes. We have seen 58% appreciation since 2017. So thinking like pre-COVID, 28% since 2020, and then still 4.5% after that major COVID burst, so since 2023. We won't touch on this today, but in that appreciation section, another point to potentially look into on your own time to keep your money working for you is that you can defer capital gains through something called a 1031 exchange. And then that third piece is equity pay down. There's the aspect of growing your net worth, and then with that, using that future capital for further investments. And then number four, I'm about to hand it over to Kevin to take over, is depreciation. Why we are all here today. This is where the tax benefits come in. You've probably heard some of these buzzwords. Kevin's going to be touching on the short-term rental loophole, accelerated or bonus depreciation, and how we do that, which is through something called a cost segregation. Um, and why all of this matters, other than keeping your tax bill down this year right now, is that it can really expedite your portfolio growth. So with that, Kevin, I'm gonna hand it over to you and dive in. Um, just so everyone knows, we will have a time for Q&A at the end, but if something is a burning question, feel free to just pop it in the chat. So take it away, Kevin.
Um, as you can see, I didn't always have a mustache and or short hair. So I am Kevin Bevillard. I am a husband, outside enthusiast. As Katie mentioned, I'm a UGA fan or Georgia Bulldog. Also, just so happen to be a CPA with a focus in taxation, and I really try and focus in the real estate space since it's very nuanced, as well as mid to small size businesses. Also a house hacker, remodeler, property manager myself. So kind of seen everything from the ground up with real estate, from short, mid, long-term rentals in and out of state, managing a house renovation from afar with a contractor to doing most of the renovation myself. So I've seen the nuts and bolts of everything, and also, understand the taxes as well, pretty in depth. So yeah, just a little bit about myself. Also, my firm, Intentional Living CPA, will have a QR code at the end if anyone wants to get in touch after this. If you just want to jump to the next slide, thank you. So yeah, we're going to be talking a lot about short-term rental strategies, or STR. You may have heard it like called or referred to as the STR loophole in real estate. And that's what we're going to be diving into, along with some other of the hot topics in the STR space. Right here, why can short-term rental investments qualify for much larger tax deductions? A little bit nuanced in the wording there, but by purchasing a short-term rental, and we'll go over the details of how to get that STR loophole, you may be able to deduct between 20 and 40% of your purchase price in the first year of having that property placed into service. Now, it's not as simple as it just calling it a short-term rental and deducting a large amount of that purchase price. There's a lot of hurdles and things to watch out for along the way when going down this path. It is, in my opinion, one of the best ways to offset your active income or your W-2 income, is with an STR. So, and how we do that a lot of times is via depreciation, and there's kind of different buckets for depreciation we'll jump into. But the traditional depreciation here, we have a very classic example. I'll just run through the numbers very quickly. Let's say you buy a property in Denver for 1.2 million, or a quadplex or something. When you buy that house or that quadplex, you, or hopefully your CPA, needs to take that HUD statement and pick apart a lot of different things in that HUD statement to get to the actual depreciable value. And part of that is saying, hey, you may have paid a million, 1.1 million, but there's some other things, closing costs with your lender. You may have some, other things in that HUD statement, some concessions or additional amounts paid that could increase your value in the property or your purchase price. And let's say it gets you to 1.2 million in this example. Well, the CPA has to then, after doing that analysis, carve out the portion that is land. There's various ways to do that. One way that your CPA should not be doing it is by just taking a flat 20%. I see a lot of old school CPAs do that all the time. It's a quick and easy, kind of a lazy way to get to the land value. The IRS has actually called that out as a impermissible method of doing that. But going back to the example, we get 1.2 million. We say 200,000 is for the land. Our depreciable basis is $1 million. Under traditional depreciation, without considering a cost segger bonus, you have to depreciate that residential property over 27 and a half years, giving you about a $36,000 deduction, which will approximate at about $8,000 or $9,000 in tax savings at your effective tax rate of 24%. Not always that easy to get that, but that's the normal depreciation. I'm sure all of you have a bunch of questions about bonus depreciation. Basically, how we juice up depreciation in the first year it's placed in service is called bonus depreciation. And again, I'm sure there's going to be a lot of questions, but 100% bonus is back after the OB3 bill passed Friday officially. It was 40% for 2025, but any property placed in the service January 19th forward is, the bonus depreciation is applicable for it. There is a nuance in the bill that I just learned of today. So bonus 100%, we'll get into what that is. But there also is a caveat in there where you can actually make an election to either take, this is not new, but take no bonus depreciation depending on your circumstances, which 99% of people don't want to do that. Or you can still follow the 40% rule for 2025. So you have 3 elections in 2025, no bonus, take 100% bonus, which much people want to do, or you take 40% bonus, which is the old rule for 2025. That 40% election won't apply to most of you all, so I wouldn't worry about it too much. It's more so for, I would say it's more so for businesses or entities that have properties and trying to plan around some interest expense limitations there.
And Kevin, we have a question. Can you define placed in service? That's when the listing goes up, not when the home is purchased, correct?
It's when it's ready and available for use. So yeah, it is, someone can move in there that day. Technically speaking, the IRS does like to see 1 to 2 unrelated party stays in there, obviously. You'd have to really, somehow show on Zillow or Airbnb if, you place a property, it's ready and available for use. Then if you get no stays, let's say it's at the end of December, you just want to make sure you track that and say, hey, we did all this work. It was sitting there. It was ready to be used. We just didn't get a bite. So I always try and tell people, get at least 1 or 2 unrelated party stays to kind of cover your bases.
Got it. Thank you.
Yeah, so accelerator bonus depreciation, what is it? Going back to our example here, real quick, $1.2 million, assume 200 for land. We have to carve that land out of the equation because the land is not depreciable. And in our prior example, we would have gotten about $36,000, I believe it was, in a deduction. With bonus depreciation, you can accelerate that depreciation on any property that's 20 years or less as defined by the IRS. So let's say you do we'll get into what a cost seg study is too, but it's basically picking apart the house for its components. If you look around wherever you're sitting, you probably have windows, you have floor trim, fans, I don't know what else, cabinets, sinks, that kind of stuff, appliances. Per the IRS code section, those do not have to be depreciated over 27 and a half years. It's the structural component of your home that's 27 and a half years. So when you do a cost segregation study, you're basically picking it apart and saying, hey, I bought this property for 1.2 million. We have 200,000 for land. Oh, I'm going to bring someone in to do a cost seg, and they're going to tell me of that remaining $1 million, let's just call it 100,000, or in this example, $300,000 in assets qualify for bonus depreciation. That could be cabinets, like I just said, that could be trims, certain types of flooring, fans, window coverings, an array of items, appliances. And so in this example, you would, instead of getting $36,000 of depreciation going back to what traditional depreciation is on its own, you, in this example, could get $300,000 of losses potentially subtracted from your W-2. So huge benefit. We're going from $8,000, $9,000 in tax savings to $75,000 in tax savings in that initial year. I think I saw. Okay, so there was a question, but we're going to cover that. Cool. So here's again, another example. I kind of won't, spend a lot of time on this, but this is a real life example from someone at Good Neighbors, who bought a short-term rental, kind of went through and did the carve out for the land, did the cost seg study, and you can see that their savings were pretty large here. So these are not just like theoreticals. You can save a ton of money against your W-2 this way.
Yeah, this example specifically is actually one of our managing brokers, a property that they bought last year. Kevin, do you want to touch on this? What is self-managed, the definition of that, or do you want to talk about that on a future slide?
I believe that's on a future side.
Yep.
We'll kind of get through, we'll kind of talk about how STRs are beneficial compared to long term. I see James as a question. Can any of that 300K carry over? So yeah, let's say your entire loss on your STR is 300K and your salary is 150 and that's all your income. That additional $150,000 of losses you didn't use will carry forward.
Yep. Awesome.
We'll get into material participation shortly, but yes, you do need to materially participate and to get those losses to offset. And basically, kind of when you materially participate, those losses go into a certain bucket. And then if you have any long-term rentals or investments you're passive in, they'll go into another loss bucket. But so real estate and short-term rentals, depreciation is probably one of the biggest ways you generate losses from year to year. It's a paper loss handed out to the IRS that basically says, in theory, hey, your property is depreciating in value every year. Well, for real estate, it's quite the opposite. In the real world, it's appreciating, but for tax purposes, they create this fiction that it's depreciating in value since you buy it, it's deteriorating from wear and tear, et cetera. So you're going to get a chunk of that to offset your income. Other tax savings and financial benefits, if it's a straight up, hey, short-term rental, if you have a mortgage on it, your mortgage interest can offset it, your insurance, mortgage insurance premiums, any operating expenses, repairs, furnishing it, utilities. I mean, there is a laundry list of stuff you can go through to kind of anything associated with operating that property as an expense is a deduction that can further increase your loss. That can then further drive down your W-2 income, getting you a much larger refund at the end of the year, hopefully, especially if this is your first year running the property. So how to qualify for short-term rental. I think there's, if I saw it correctly, there was a question in there about long-term rentals or something.
Yes. Can you hear me still? Yeah.
Yeah.
So we have a couple questions. We're gonna go over material participation and then the difference between self-managing and having a property manager, and the fact that these are for short-term rentals only and does not apply to long-term.
Yeah, so I touch on the long-term thing real quick. Basically, by default, per the IRS, rental property is passive. Back in the 80s, they basically said, hey, you're going to have two lanes if you're a W-2 or self-employed individual and you have rental properties. You have your active income, which stays in this lane. That's your W-2. If you're self-employed, that's your Schedule C or your business you're running. And then in this lane, you have your passive activities, which is, we'll just keep it to rental real estate. Those do not cross each other. So if you generally, the default is if you have a loss in your passive activity bucket, that cannot cross lanes and offset your W-2 income. However, per the IRS, this short term, which we'll define shortly, if you qualify for these hurdles and you meet all of them, they basically exclude short-term rentals from the passive activity rules. So those losses now, if it's a short-term rental, can cross lanes into that active income bucket and offset your W-2 income for, and one of those hurdles is 7 days or less. If you on average rent the property for 7 days or less during a year, that is one of the hurdles. For long-term rentals, right? You're doing a year-long lease. That's not a short-term. So generally speaking, unless you hit some other hurdles for that long-term property, and again, this is just the default for it. There's some exceptions. That long-term rental loss will not offset active W-2 income. But if you have multiple long-term rentals, some are generating income, some are generating losses, those offset each other. And you don't lose any losses you don't take that year. They carry forward until you have passive losses from other long-term rentals or you sell the property. So I just saw another question about long-term accelerated depreciation. Yes. In that case, I always advise if the client's cash flow and cash needs make sense for a long-term rental to do a cost seg, because it's more hurdles to jump through down. You can still do a cost seg later on for your long-term rental. It's just going to cost more to do it because there's some tax hurdles to jump through to get that benefit. I think those are the two big ones, long-term and accelerated. No, they should carve that out. So lender, I'm not a lender, take this as lending advice. Stacy might be able to help you, but lenders should be carving out certain items on your Schedule E. Depreciation is one of them to qualify for loans.
Yeah, and I'll just hop in here.
Yeah,
The
great.
accelerated depreciation is freaking fantastic and really helps you qualify for whatever you want to buy next. So I love depreciation on tax returns. I don't like miscellaneous expenses because I have to pull those back, but depreciation I can add back in.
Yeah, it's like getting your cake and eating it too. You get this massive tax benefit that could potentially give you a really big refund at the end of the year that, you can then take that refund, get another property, and that bonus depreciation doesn't really kill your debt to income ratio on your Schedule E.
Yep.
All right, how to qualify for STRs. We'll bank some of these questions to get through most of the slides, and hopefully, Katie, if you want to kind of keep I have no idea how to rolling dialogue that we can go through some of these, but what rules do I need to be aware of to qualify for this quote unquote loophole? So the first one I already touched on, 7 days or less. Your average guest day for that tax year, so whenever you place it into service through December 31st, needs to be 7 days or less. And you have to also materially participate. I think the next slide gets into material participation because that's one of the big ones.
Yes, yep, we can dive in there.
Yeah, the 7 days or less one's pretty straightforward. Airbnb, all that stuff should track that. If you're operating off multiple platforms, they should be able to give you that, or you just pull up your calendars and look at it. The 7 days, there's 7 tests for material participation. So, right, let's just say you got the 7 days or less. Now you need material participate. There's 7 tests. These are the 3 most common ones I see. The first one is you spend over 500 hours annually on that tax return. So from whenever you place in the service through December 31st, you worked on that property for 500 hours. If you worked 550 hours, those 50 hours do not carry over to next year. So it is that tax year for you. difficult to hit, but not impossible, especially if you're kind of like furnishing it, painting it, you know, slapping some trim in, etc. Um, the next test is you're performing most of the work or substantially all of the work in the rental property. And Internal Revenue Code 469 is where a lot of the real estate stuff is. It does not define substantially all, because that's, I believe, the exact wording they use. But in that case, we look to other sections of the code, and it's generally around 70%. If you can prove that you spent at least 70% of the hours that were worked on the property yourself, that is another way to qualify for material participation. The last one, and the most common / probably the easiest one to hit, is participating over 100 hours and nobody else spends more time than you. So that means for all three of these, generally speaking, except for maybe like the 500 hours, you need to create and keep track of a log of where you work. So what property, the address, if you just have one, it's pretty straightforward. When you were there, what you were doing, for how long you were doing it. These don't have to be like novels, but it is the most reliable source data for the IRS if they ever came in and looked at it, that you have already created a log substantiating that you meant material participation. It's not terrible to retroactively go back. You just want to be careful because they'll pick that apart a little bit more than if you proactively already were tracking your hours in this situation. So the next question people might be asked or thinking is, what qualifies as hours worked on the property, right? Generally think about anything that changes or impacts the day-to-day operations of that property. So that's repairs, maintenance, client requests, cleaning the property yourself, installing things, collecting rent, guest issues, all those hours. Again, you're impacting the day-to-day operations of it, qualify for material participation. And if you're married, you can combine yours and your spouse's hours into one to meet all these. That's not the case for some other rules, but for STRs, luckily you can combine your hours. Going back to, so we already talked about what qualified, what doesn't qualify. Doing your monthly bookkeeping or pulling together stuff for your taxes do not qualify. Education, listening to podcasts, reading books do not qualify. And then the last one I generally try and stay away from is travel. I tell people, you know, log your travel and for what you were traveling for, but do not rely on those to hit these tests. It's a pretty contested area. In some court cases, is travel logs, do those count? So the next thing is, you kind of gone through the life cycle of this property. I won't go into too much detail on this, but when you take depreciation, whether you take bonus depreciation, whether you take normal depreciation, there's a thing called depreciation recapture. That is basically the IRS saying, hey, we gave you a really great benefit when you bought this property, and we did that to spur the economy. You have a tax, and everything the IRS does is some kind of tax incentive. They're pushing an agenda. So they want people to buy, you know, working assets to move the economy forward. We're going to give you this great depreciation recapture. Oh, but when you sell the property, if you have a gain on the property, you might have to repay that amount, the effective amount back. So this is something to have a separate conversation on, but depreciation recaptures, generally, you got this great benefit, you may have to pay some of it back later on. So if you're buying a rental property and you're only going to hold it for a year, and you want to really maximize the benefit and take bonus, just remember that next year when you sell it, you could have a large tax bill, and it's probably going to be due to the depreciation you took in year one. There are planning opportunities around this though. So definitely talk to a CPA, your CPA, because tax years, people's income brackets shift. So there could be a huge benefit, some arbitrage here if you know what you're doing and you're planning ahead. So depreciation, I see a question just real quick, recapture in context of 1031 exchange. A 1031 exchange won't get into detail because it's one of the more complicated code sections out there. But by doing a 1031, if you properly do it, you can defer taxation, or you can totally defer the gain that you would otherwise have to pay taxes on if you did a proper 1031. So it's essentially kicking the can down the road, so to speak. Boom, 1031. Pretty complicated, I'm not gonna lie. You can do a 1031 on your investment property to defer any gains, capital in ordinary, which is depreciation recapture, is also kind of, it's taxed at your ordinary tax rates. A lot of specifics with 1031s here, not going to get into them, but this is when you jump from one property to another of higher value than the one you were in. You're just trading up essentially in a 1031 in most instances, and you're deferring paying taxes on that gain. Yeah, this
Kevin,
is something, yeah.
could you be clear, especially to Zara's question, though, that the depreciation recapture, how does that play into purchasing another property? Does it apply, or like would that have to be repaid in the event of a 1031 exchange?
In the 1031, no, you would just defer.
Okay.
So,
Yep.
but one thing, not trying to go down a rabbit hole with 1031s, is that your basis for depreciation in the new property won't be as high as you think it will be. You're basically taking this house, going back to our original example, if I remember the numbers correctly, it was $1 million of depreciable basis. We took 300,000. Your tax basis is now $700,000. When you 1031 into, like, let's say a $2 million property, you still track that $700,000 basis. So you're kicking the can down the road in terms of that 300K of depreciation you already took. And again, 1031s probably need like several hours to go through them. But the gist is, you do a proper 1031, you don't have to pay taxes on that gain you may have otherwise needed to recognize.
Got it. Yep. We'll probably have to do a future presentation on 1031s.
They're remarkably confusing.
Yes.
One thing, so I had a client ask me a pretty good, he didn't even ask me a question, he just kind of posed it theoretically a few days ago, and I was like, I should probably clarify this on the slide because a lot of people miss this. Short-term rentals, they're probably cool houses in cool locations doing cool things, right? You want to use them yourself up in the mountains, in the woods, next to a river. Personal use days could really mess up your plan to offset your W-2 income here. So they could swing your STR from being a rental to being a residence, which is huge difference for the IRS. Okay, you're going from operating a business to a residence, and the difference is residence you cannot take a loss on. So if you use the property for more than 14 days, or it's the greater of 14 days or 10% of the total days rented out, I try and keep it at 14 days your safe harbor. If you use it for more than 14 days in this instance, you could limit your losses to only your rental income. So you could take a massive haircut on the losses you are expecting to get to offset your W-2 income. You don't necessarily lose those losses, they're suspended, but those, yeah, it's a huge it's a real disappointing thing to come across, that when people are like, oh, I have this house in the mountains and we used it for 37 days for family vacations, and I'm like, well, that is unfortunate for it sounds great, don't get me wrong, I would love to use a house for 37 days in the mountains, but for taxes you might be being thrown a curveball here. And so the definition of personal use, generally it is you are using it yourself or family members are using it, even if your family pays fair market value for it. That doesn't matter if kids, grandparents, your wife, brother, sister use it. That is a personal use day. If you use it, that's a personal use day. If you generally rent it out for really below fair market value to friends, that's a personal use days. Um, and swap use of units, I don't see this as much, but if you're giving somebody your beach house for a mountain house, that's personal use day right there. So I tell clients, try and meet exception one, exception two. It's not that real relevant for STRs, but exception one is if you go to the property, let's say it's up in the mountains, and you got to install a sprinkler system or something, as long as you track your hours for that day and you generally work at least 4 hours that day, that entire day does not count as personal use. So example, you need to install a sprinkler system at your mountain house. You go up there, you take 5 hours to install it real early in the morning. You then have the rest of the day to go hiking and you enjoy it that afternoon and that night. That would not be a personal use day. How do you prove it? Yeah, logs. Like I said, the most reliable thing are, proactively creating logs. And if it really gets down to the brass tacks of it, the IRS will look at your credit card statements, your calendar on your laptop. They'll even dig into emails, texts, that kind of stuff. I think at the last meetup, I gave an example where a lady was trying to meet the material participation. So a little bit different, but just to give you kind of an inside look at it, she was claiming she worked on the house for 6 hours or 8 hours 3 days in a row. Well, the IRS went and saw her credit card statement said she was in Paris. So any goodwill she had or any trust the IRS may have had in her at that point got blown out the door. They will look at those things to make sure you are at the property in town. So in our example, they would look for your credit card statement to see if you spent money at Home Depot for sprinkler stuff, your receipts, if you have any receipts, that kind of stuff. If you booked on your calendar, they'll go backwards to kind of look at that too. So,
And to be clear, that's all in the event of an audit. That's not
yes.
something that no matter what they're going to ask for. Yeah.
Yeah, all these logs and stuff that I'm talking about, these are for you to sleep at night, in case you get audited. So that's what the IRS is looking for. That's what the burden of proof is on you to be able to show to them, hey, I meet all these things, and here's why.
All right, we're gonna move on. Kevin, before I dive into Good Neighbor, anything else you want to touch on before we get into Q&A as well?
No, I'm sure a lot of the other stuff will be touched in the Q&A. People can fire away.
Sounds good. Okay, guys, before we dive into Q&A, I just want to touch on, especially for anyone here that does not know Good Neighbor, has not been to an event before, Good Neighbor has a ton of free, emphasis on the free resources. From events, we have many virtual, and if you are Colorado based, we have a ton of in-person that I highly recommend. It's a great way to network as well and get to know people in this world. We have a seller's guide and a buyer's guide. Another really great thing that we have is our B&B Financially Free podcast. I highly recommend, especially if you're new and learning, listen to every single one. They are awesome, great learning opportunities. And then one of our bigger opportunities is our short-term rental pro course. I will say that I don't remember exactly how much we're selling it for right now, but Good Neighbor clients receive this absolutely free. It's about 6.5 hours getting into the weeds of starting an STR investment property, from sourcing the deal all the way through getting that listing up and being successful in that. And then the last thing I'll touch on is when you work with a Good Neighbor agent, we are doing investment property underwriting for you. We share our pro forma, we share the background of the pro forma, and why we think a property will be a success. So let me go ahead and, oh, this is a plug for if you are local. I have an event coming up July 29th. It is women only, so I'm sorry, guys. You're gonna have to sit back on this one, but this is the RSVP for that. I am doing it with one of our lenders who I absolutely love. Her name is Jessica. She is investor focused and helps people understand how to leverage and yeah, how to expedite growing a portfolio safely. Um, this is a QR for our course. Again, all clients receive this for free. It is extremely helpful, especially for beginners. This is 2 hour BNB financially free. Of course, you guys will all be receiving both this presentation and the recording, so you'll have all of these QRs. Um, you can follow us on socials to stay up to date. And now we'll dive into Q&A, but these two QR codes are if you would like to book a call with myself or with Kevin. Kevin's QR code goes to his website, and then you can just scroll down to get in touch with him. And mine goes straight to my Calendly if you would like to chat further. So let's go ahead and open it up. You can either I'll monitor the chat or feel free to unmute yourself and ask questions directly. Um, let's start with, we had a question. Can you touch on, Kevin, how the IRS views STRs that flip to long-term rentals down the road? Um,
Yeah,
yeah, go ahead.
yeah, perfectly acceptable. Some things in our example, per the IRS, a residential rental property is depreciated over 27 and a half years. However, if it's a short-term rental and the IRS defines that differently than the 7 days, they say 30 days or less, it's called transient property. And at that point, so a midterm rental could qualify for this. You have to flip the depreciation from 27 and a half years to 39 years, the normal depreciation for the structure of the home. Um, but yeah, I had a client, and I've personally done this, where sometimes you just kind of get burnt out at STRs, or you're not in town to manage it for a year or something like that. Perfectly normal to flip it. I generally say STR property the first year. And if you don't like it, it doesn't work for your lifestyle, you can flip to a long-term rental. Now, in that first year, if you do a cost seg, you do bonus depreciation, you get all the benefits right there. If you switch it to long-term rental in year two, you might not get any losses to offset your W-2 income, but it's not prohibited or anything like that. It's essentially, hey, I'm going to use this STR thing, put up with managing it, cleaning it myself for a year, see how that goes, and get the benefit of a cost seg and a large write-off, hopefully.
Awesome. Thank you, Kevin. A question for myself, we do have partnerships to other STR focused agents in other states. Some we have a go-to person for that state, and others will work our own network to find someone for you. But certainly, yes, you can reach out, and if you're interested in another state, we'll make sure that you get placed in good hands. Kevin, can you back to the passing of the 100% bonus depreciation? Can you explain more about the January 2025 effective start date for the new bill? Does that mean if we purchased a property today, we wouldn't be able to claim 100% bonus depreciation?
Nope, it's just as long as the property is placed in the service, so ready and available for use, January 19th, 2025 forward, you qualify for that 100% bonus. Unfortunately, if it's placed in the service January 2nd, you are subject to the 40% rule, the old rule. And January 19th is, I believe, the inauguration date, if I'm not mistaken. So
Yes, yeah.
it's a very odd date, but yeah.
Yeah. Yep. So yeah, Kelly, to be clear, if you were to purchase today, you get to take advantage of the 100% bonus depreciation.
Yeah, and they say it's 100% bonus depreciation permanently in the code, but as we all know, nothing is permanent. So in 4 years, it could go away in theory. So
Yes, and then so it ends after January 2nd, 2025. No, to Kevin's point, so anything placed in service, let's see, for example, if we bought one on January 2nd, 2025, it would only be 40%. Correct.
It's
Well,
it depends when it's ready, it's placed into service.
yes, thank you.
So yeah, if you bought it January 2nd, you did nothing with it until today, it would be ready and available for use today, July 9th. So you would qualify for 100% bonus.
Yes. So again, it's not based on the purchase price. It is the date it is based on is when it is placed into service. Another lovely, more gray area.
Yeah, I really just wish they made it January 1st, but
Sorry, do you care if I unmute myself? I keep. if
Oh,
that's
no, Kelly,
easier.
go ahead. Yes, go ahead. Anyone can do that now.
yeah.
We just have a window where we can, as long as, I guess I just don't know if I fully understand. So if we have one ready to go, let's say that we have one ready to go on January 5th, that wouldn't count because it has to be in by January 1st. I guess I'm just confused. Like, are we on like a limited window for the 100%?
No, it's from January. So the old tax rules, let's just back up. And for 2024, bonus depreciation was only 60% of applicable property. In 2025, it got reduced down to 40% until this past Friday. So in the new section, if your property is ready and available for use, it's placed into service January 19th or forward, you can take 100% bonus depreciation. If it wasn't, and it was in between January 1st and the 18th, you're subject to the old tax law and only able to take 40% bonus depreciation. So what I'm telling clients is if they fall into that awkward window of January 1st to the 18th, really check your calendar for make sure that you have the date correct of when it was placed into service. So just think January 19th forward, 100% bonus. Anything before then, subject to the old rules, which would be 40% for those 2 weeks in January, for at least 2025.
Does that
That
clear it
kind
up
of,
for you, Kelly?
I'm honestly still a little confused by that, but I don't want you guys to stick on that too much for me. But basically, you're saying if we bought one today and had it ready to go in a month, that would count for.
100%.
And
Yep, exactly.
if we bought one, like what if we bought one in March of 2026? Would that still count for 100%? If we, I mean, I guess what I'm more curious about is like later on next year if we bought another one. Is it
As of today, for the rest of our lives, it's 100% bonus depreciation because it's a
Until-
permanent, until someone wants to scrap it, essentially. But currently, there's no quote unquote sunset provision. It's not going away. If we chug on with the rest of our lives and nothing changes in the tax code, you will have access to 100% bonus depreciation until you die.
So
Okay.
essentially, you can think about it also as for the next approximately 4 years while the current president is in
Administration's in
office.
place.
Exactly.
Yeah.
Gotcha.
I mean,
okay? Thank you.
Yeah, for sure. All right. Any other questions? I think we've covered everything in the chat. Feel free to add them to the chat or unmute yourself.
yeah, this is a super nuanced space. You can go into like a bunch of questions. I will say if you're getting an STR, I do not recommend trying to DIY your tax return. I can't tell you the number of times it's just incorrectly done one way or the other, and a lot of CPAs don't fully understand this space. So make sure the CPA you're talking to kind of understands the real estate space, especially STRs, because I've seen some crazy things done on these. People Schedule C or CPAs telling them they can't do a cost seg or subjecting them to self-employment taxes on their rental income. So yeah.
We have one more. Do hours you put in before closing on a home count toward the material participation?
No, it's from ownership until December 31st. The IRS would probably look at that as like research type
Mhm.
of like looking into the property, running an analysis, going through a lender, getting your stuff ready. Those hours would not count.
Yeah, okay.
No, that was clarified. So the question is, does income from the STR count as self-employment? Or I'm assuming you're trying to say, is it subject to self-employment tax? I believe that's Marla, if you want to clarify. Because yeah, the only thing that confuses me is the tax deduction. You do get a self-employment tax deduction, but STRs for the code section that they're in, which is IRC 469, do not qualify as quote unquote rentals subject to the passive activity loss limitations. I see it all the time where a CPA may have initially read it like that and then throws them into what's called a Schedule C, which is wrong because that Schedule C income gets subject to self-employment taxes at 15.3%. So you're getting subject to the income tax and the self-employment taxes, but no, STR should not be subject to self-employment tax if that's what you're referring to.
Yeah, feel free to Oh, okay, great, Marla.
Okay.
I'm glad that. And then I think that touches on your question as well, Zara. But if you have any further questions, feel free to unmute yourself.
Yeah, they came out in 2021 with the chief counsel advice, and it basically clarified this point, but it was already, yeah, STRs should go on Schedule E, not Schedule C, for multiple reasons. Self-employment tax is one of them, but also if you didn't hit material participation and you put it on your Schedule C, you're now taking a loss that you're not entitled to. So Schedule E is where they go. And backtracking with material participation, it's by property. So I meant to touch on that. So to hit those tests, you have to look on a property by property basis. So it's not, oh, I worked on this STR over here for 100 hours, but only 10 hours on my STR on the other side of town. The one you worked 100 plus hours on would probably qualify. The one you worked 10 hours on would not. Those losses would not be able to offset your W-2 income. There is an exception there. It is a grouping election. I won't get into the details of it, but making that election is something to really dive into with the CPA because there's some specific things to think about down the road if you were to do that. Yeah, material participation is year by year. January 1st through December 31st, which is all of our tax years.
And can I just ask a clarifying question with that really quick? Might be easier to get versus.
Of course, yeah.
Let's say that you do it in year one. I know that you said you can easily transfer it to like a long-term rental in year 2, 3, or subsequent years. But let's say that you wanted to keep it a short-term rental and not self-manage or not material participate in subsequent years. Would you have to pay back any of that bonus depreciation if you chose to do that?
No, great question. So you're essentially kind of flipping it but offloading management and not materially participating. It would just go into that passive activity bucket. So no, you wouldn't have to repay. There would be no depreciation, recapture, repayment, or anything. It's just you change the character of what that asset was doing for you.
Got it. Thank you.
For sure. We have in your example, after the 300K bonus depreciation in the first year, would the remaining 700K be depreciated over 27.5 years?
Yes, with the caveat that it would be technically 39 years if it was a true short term. In our example, we put 27.5 years because generally residential properties that aren't short-term rentals. And it's confusing, but short-term defined by the IRS is 30 days or less. In this instance, you would depreciate over 39 years. But yeah, that 700K is still depreciable.
Yep.
If you put an STO into service November, do I have to hit the 100 hours before December to qualify? Good question, because that's pretty hard to do, right? You're definitely not hitting 500 hours between November and December. That would be not impossible, but kind of difficult to do. To hit the 100-hour mark, yes, that's kind of a how do I say this? Just not foolproof, but it's kind of giving you, you are 100% safe if you hit that. The third one that we talked about is if you substantially performed all the services. So you still have to track all your time, but prove out that, hey, I spent 77 hours putting together IKEA furniture on these weekends, and they're not 100, but no one else did any other work besides me, so I substantially did all the work. So you could hit that third one we were talking about if it's later in the year, which would qualify for material participation, which then you can do a cost seg study and get that bonus depreciation.
So it is for material participation, it goes the calendar year. So it doesn't like start the day you purchase the property. It's actually January till December.
No, that's just like the calendar year. So yeah, if it's your first year, it'll be from, ownership to December 31st. If it's your second year, it'll be January to December. And again,
so if we purchased a property and had it up and running in October of this year, we could still claim the 100% bonus depreciation, and we would have a full calendar year to get our 500 hours in. Is that what you're saying? Or would they all have to be completed by the end of the year?
end of the tax year, December 31st. It's done tax year. You have to think of every tax year in a silo. So hours do not carry over to the next tax year. It is from purchasing the property, doing all the work to get it ready for being rented out, and then all the work while it's rented out. Could generally those hours qualify until December 31st. And then it restarts next year.
To be clear though, Kelly, I'm not sure if you were here when we were on this slide. Sorry, I'm almost there. Kevin touched on that there are a total of 7 tests for material participation, but these are the 3 main ones. So what he just explained was that you don't need the 500 hours, especially like that's impossible to do if you purchase the property in October. So that's where number 2 would come in, that you are performing most of the work in the activity yourself. And as a married couple, that applies to both. So Kevin, correct me if I'm wrong, but I want to be clear that you don't have to hit even 100 hours between October and December. You just have to prove one of these 3 things, really 7, but these are the 3 that are the easiest for an investor.
Yeah.
So, and at that point, you are probably looking at number 2, where you are performing majority, 70% or more is what Kevin leans on of the tasks. Does that make sense to everyone? Because I know, I mean, that's where we're at, is people who are looking to purchase property, even if you're targeting Q4, like this is the important part to understand.
Yeah, like the 100 hours, number 3 below, is probably the most common that I see, but I do tell people, hey, you're not totally screwed over if you buy it in November and get it up and running in November, December. You just have to, again, track your hours, prove that you did most of the services, if not all of them, cleaning, putting the furniture together, answering guests, that kind of stuff.
So is it pretty impossible to prove material participation if you use a property management company?
Yeah, that's a very bad fact pattern.
That is partly why, especially like Kevin said, year one, we highly, highly recommend self-management. Um, Especially if you're buying toward the end of the year and you're self-managing, and then the following year, if a property manager is of interest, then you're in the clear.
Yep, it is. That's a pretty easy tag for the IRS to see that you're taking these losses against your W-2, but then there's a management expense line on Schedule E. If you have that on there, then uh yeah, you're poking your head up a little bit too high.
All right.
Um,
Well, oh, go ahead.
Sorry, just one last question. I cannot hit any of the tests this year, but can hit one next year. Can you claim the bonus depreciation year two? No, it is the first year it's placed into service. There is a caveat there. The general rule is you take bonus depreciation in the year the property is placed into service. So that first year, you can elect out of bonus depreciation, but it's irrevocable. So it's not like you can elect out of it and then take it down the road if you make that election. The kind of the way around this is if you know you're not gonna STR it for the first year, 2 years, you long-term rent it or whatever, don't do a cost seg study. And then in year three, you're like, hey, this is gonna be a short-term rental. I'm gonna hit all these benchmarks. You can do a cost seg study in year three, get your bonus depreciation, hit all the 7 days material participation, offset your W-2 income. However, the CPA you work with will need to know the rules on doing this. You'll need to file what's called a Form 3115 and do a 41A analysis. That means nothing to most of these people on this call. But that's essentially how to get around if you know in year one or year two you're not gonna hit this, but like, hey, I'm going from full-time W-2 to part-time in year three. I'll have the time to clean and renovate and do all the stuff on my short-term rental at that point. Save your cost segregation. It's kind of a lever you can pull in that situation. It's going to cost more money because the CPA has to do this whole analysis in this whole other form that's not inexpensive, to basically catch up and do that bonus depreciation in year three when it is an STR. But it is kind of a unique thing, and there's certain facts and circumstances you want to make sure you have right in that instance.
Got it. Thank you.
I was about to
All right.
say, this is Aaron. That's an interesting point because I was just thinking about how many people buy mountain properties now and can't do that because they're being limited by permits. So they're stuck in that 30+ day rentals. And I'm part of a small STR down in Pagosa, and we have that problem. We're almost towards the end of it, so we would be in that same situation that you just mentioned, where essentially year three we could STR it.
Yeah, and if you didn't do a cost seg, that's maybe the time to think about doing it. I don't know the specifics, but it's yeah, it's kind of a crazy thing you can do if you're in that situation.
Yeah. Are there any, and I don't know if this was brought up or mentioned at all, or even if it applies, but are there any caveats to having this in an LLC versus just putting it on your normal return?
So an LLC with, let's just say you, Aaron, own an LLC that owns this house, you're a single member LLC, doesn't change any tax dynamics. If you're in an LLC, like everything will be almost the exact same besides like 2 lines on Schedule E that don't change the numbers at all. However, LLCs come into play and change the tax dynamics when you are bringing outside partners into a deal. Then dynamics, everything of STRs changes completely. Gets a little more convoluted, who materially participate, who doesn't. You'll get a chunk, you'll get a K1. Essentially, if it's a partnership, don't ever put a real estate in an S corp. But yeah, the dynamics do change if it's not just you, it is an outside party coming in and investing with you.
Okay. No, that's interesting because we do have this particular one in an LLC between 3 people. And yeah, I think what you're mentioning with regard to material participation gets probably pretty gray in that respect when you got different partners in there.
Yeah, generally speaking, you're gonna have one partner actively managing it. They'll materially participate. The other two partners generally will have to be passive. Um, and you're probably filing a partnership tax return right now, I assume.
That is right. Yeah.
Yeah.
I'm
So
just wondering because I'm sure there's a lot of people that do this, right? They put their different investments in LLCs for liability protection, and
Yes. Yeah.
that's an important thing to consider for everyone because you're trying to take advantage of that depreciation, but if that's going to make it hairy on the material side of things, then yeah, probably.
yeah, it could definitely you definitely want to be the active managing partner in that situation and prove that you materially participated in that partnership with that rental property to kind of maximize your benefit in that situation. But if you're not, those losses will be passive. They'll come over on your tax return and they'll sit there until you're able to use them. So it's kind of like you're just building a cachet of losses to offset potential future income from that partnership or other passive rental activities. Or if you sell the property, they get unleashed. So against all your income. So it's not like you're, you know, down the creek without a paddle type situation. You do get a benefit. It's just not immediate.
And there is no expiration on that, right, Kevin?
Yeah, yep. The 3 ones are you either have passive income to offset it, to use those losses, you sell the property, those losses then get quote unquote unleashed against your income. It's a free for all. They can offset your W-2 income, or you just kind of die. So
Okay.
the easiest answer to taxes is just kind of dying, unfortunately, because then you don't have to pay them. And your heirs inherit a lot. So
Yeah, we used a 1031 actually for that particular investment, so that worked out for us.
nice.
I know you really just touched on this, but we had one more question come in. Speaking of partners, is there anything you frequently see that we should keep in mind when entering partnerships? How does bonus depreciation get split?
Yeah, one, like your partner, trust your partner, but get some ironclad attorney to write up everything you can think of that could occur poorly between y'all to shield yourself. Can't tell you how many times I see, especially unrelated people enter into partnerships and um, usually disagree on stuff. Someone's working too much, someone's not working enough, doing stuff wrong, and it breaks apart. Just making sure definitely get an attorney involved, definitely get a CPA involved beforehand to kind of vet out all the partnership specifics. In terms of bonus depreciation, let's say you and a friend enter into a partnership to buy an Airbnb. Going back to our example, you get 300,000 of bonus depreciation at the partnership level. If you're a 50% partner, technically you would get 150,000 of bonus depreciation on what's called a K1, which then flows into your individual tax return. Yeah, partnerships is vetting the person and making sure you're getting all these other pieces involved, because unfortunately a lot of times partnerships eventually do fail, and a lot of times I've seen it just not kind of gets ugly at the end and people want out. So
All right. It's 6:10 here in Denver. We're gonna call it. If you have any other questions, feel free to reach out to us. Those QR codes are still up there. Everyone will be receiving a recording of this and the presentation as well. I would love to very quickly, before you hop off, vouch for Kevin. He is my personal CPA. I would recommend him to anyone. So if you are in need of a CPA, make sure you get on his calendar and start getting prepared for a plan for the end of the year to get that tax bill down. All
Yeah,
right.
thanks, Katie. Also can speak to Good Neighbors. They have a excellent underwriting Excel sheet. Katie's kind of involved in real estate herself and running it pretty successfully. So definitely get in touch with one, if not both of us.
Yep. All right. Have a great night, everyone.
Thank you.
See ya.
Thank you. Thank you. Bye.